Imagine owning dividend stocks that not only throw off a high dividend yield today, but it continues to grow those dividends over time. And the icing on the cake is that the stock is currently undervalued, so you have the potential to benefit from tremendous stock price appreciation. Those three things, high dividend yield, growing dividends, and undervaluation, is the trifecta. It's the triple threat. And in this video, I'm going to share with you 3 companies I've been buying that I believe fits all 3 of those things. But in addition to sharing what the companies are, I'm going to tell you why they might be deemed risky, but also why I believe they are very undervalued. One of these companies could cover your power bill literally, and another one owns world-class real estate. And the third one is a REIT that you possibly have walked by and didn't even know they owned the property. So let's break them down for you so you can decide if they're ones you should consider buying in your account. This is a situation when I get excited about a company. It has to have 3 things. First, I like that nice high dividend yield. That means it's a cash cow. That means it's putting nice cash into your pocket starting from day one. That means you don't have to wait 20, 30, 40, 50 years for the dividend to grow to something substantial. Rather, you get nice high starting dividend yields in your pocket today. But I don't want just high dividend yields today and it kind of stays the same. I want those dividends to not only be high starting today, but I want them to continue growing. And I want them to grow at a reasonable pace. And then the complete icing on the cake, and really it's become one of the ones that I insist on. I want to invest in a company that I believe is fundamentally undervalued. That way I can buy low and sell high if I decide to. So high starting dividends, high dividend growth, and undervaluation, that to me is the perfect stock if it's fundamentally solid. The first high yield, dividend growth, undervalued company I've been buying recently is EIX, Edison International. I'm going to share the important information about the company with you so you know the strengths and the weaknesses, as well as the risk and the potential opportunity. First, our dividend rate. It has a nice high starting dividend yield of 6%. That's important factor number 1 for me. But I think you'll agree with me that a high starting dividend yield all by itself, it might actually not be smart to invest in a company just because it has a high starting dividend yield. So let's look at some of the fundamentals to see where it's at from a fundamental standpoint. And what's interesting is that here on Seeking Alpha, it gives it really nice grades. From a valuation perspective, it gives it an A+. But notice that based on its long-term fundamentals, it's consistently undervalued as you see here. For example, if you look at its price to sales, it says it's currently trading at a 22% discount. And its price to book value is trading at a 21% discount. And of course, you see its yield, and that's one reason why it's so high, is because it's trading at a 32% discount. Or basically, the yield is 32% higher than what it normally is over the past 5 years. Now let's look at the financials for EIX, for Edison International. Let's see how it's doing from a financial standpoint. So total revenue is looking good. We generally see increases in total revenue. In 23, we had a little bit of a dip, but overall we see a nice upward sloping trend line here. What about net income? Notice that 9 of the past 10 years has seen a positive net income, and most of the time it was nice and positive. Now the 1 year in 2018 it was negative, but overall we do see nice, consistent, positive net income. And now let's look at our balance sheet. Here we see nice total equity. Notice that over time it has gone up, although the past 4 years has kind of stabilized. So not tremendous growth in equity, but it is strong. And what about its net income? Here we see again that 9 of the past 10 years, EIX has produced nice positive net income. Just 1 year in 2018 did it have a negative net income. So overall, a company that I feel is fundamentally sound. Yes, they are facing some challenges, but from a fundamental standpoint, I feel comfortable in Edison International being a small piece of my portfolio. So if the fundamentals look pretty good, why is the stock so beaten down? And understand this, whenever a stock is beaten down, there's almost always a reason for it. So you want to research what that reason is, so you make sure that you feel comfortable with that risk. And I did that before I started buying the stock, but you should do it on your own. But let me briefly tell you some of the challenges that Edison International is facing right now. You see this top headline here on Seeking Alpha, which by the way, if you like what you're seeing on Seeking Alpha, I have a link down in the description for you to get a free trial and also a discount. But you see that one of the challenges is some wildfires in California. There's some potential lawsuits they're fighting through. So that's definitely presenting a challenge for EIX. And that's one of the big reasons why the stock price is so beaten down right now. But in my opinion, the worry and the risk that those fires pose to Edison, they've probably been priced into the value of the stock already. Now, of course, it could end up being worse than everyone's thinking and the price could drop further. But as of right now, based on what I know about the company, I believe it's undervalued. But overall, I feel comfortable with the risk. I like that I'm getting a nice high starting dividend. I like that the dividend has proven to grow over time as you see here. And I like that I'm buying it at what I consider a nice discount. And literally, this is a stock that if I own enough of it, because of that nice high starting dividend yield and the dividend growth over time, it can literally pay my power bill for the rest of my life. Before I move on to the second stock that not only has a high dividend yield, but has proven dividend growth over time and is fundamentally trading at an undervalued price, let me ask you, which dividend stocks are you buying right now? Which ones are your favorite? Let me know down in the comment section below. Now on to my second dividend stock I've been buying over the past month or two, and it's just number 2 of about 20 stocks that I've been buying that I believe are fundamentally undervalued. But these are some of the higher dividend yielding stocks that I've been buying. The next stock is Alexandria Real Estate Equities, ticker symbol ARE. And it also has a nice high starting dividend yield. It's actually higher than S International. It's paying a 6.16 dividend yield. Let's first take a look at some of its financials. Then we'll look at its dividend history. Then I'm going to show you some of the properties it owns so you see just how high quality of properties they really are. All right, first we see its revenue. Notice we have nice, consistent, high growing revenue over the past 10 years. And what about operating income? We see more of the same. We see nice, high, consistent growth in its operating income. Now, net income isn't as pretty of a graph here, but do notice that 9 out of the past 10 years has a positive net income. Now let's see if the company is growing. Notice under total assets, we do have nice growth. It did experience a lot of growth about 5 years ago, and it has slowed some, but it is still growing. And we see its liabilities are not outpacing its assets. They too have been growing consistently over time to match the assets. But overall, total common equity, it too has been growing, although notice over the past couple of years, it has come down just a little bit. And finally, let's look at net income. Here you see a little bit of the challenge it's been facing and possibly one reason why the price has come down. Notice again that 9 out of the past 10 years has had that positive net income. And the 1 year where it was negative, it wasn't negative by much. And notice where our cash flow from operations, it's had nice, consistent, upward sloping growth in its net cash flow. Now, December 24 was a little bit lower, but not much lower. Now let's look at its dividend history. And we're going way back here. This chart goes all the way back to 1997. So notice it had nice increasing dividend, but in the Great Recession, it did cut its dividend. It went from 80 cents all the way down to 35 cents. So more than cut it in half, but just a little bit. But since that time, we see it has a nice, gently sloping upward line here. And that's the kind of dividends we like receiving. Now do notice that recently it has kind of leveled off, but overall we do see that over time that dividend is increasing. Now remember what this chart looks like, okay? Think about how consistent that dividend chart looks like. Now notice its stock price. It's really all over the place. So whereas the dividend is very consistent, the stock price is all over the place. And that to me, as long as the company is fundamentally sound, that usually means opportunity. Now let's learn a little bit about Alexandria Real Estate. Notice it's a real estate company and its properties are geared towards essential life science industrial type of companies. Over the past 30 years, they really have grown to become a solid company that provides these high demand real estate properties. They own some of the most valuable medical research campuses in the world. So we have a nice high starting dividend yield. We have a nice growing dividend over a long track record. Now the question is it potentially undervalued? Let's see. Notice from a price to book value, it says it's about 44% undervalued. And that's based on the past 5 years history. From a price to cash flow, it's about 20% undervalued. Its dividend yield is about 33% higher than what it typically is over recent history. Now we'll look at some numbers that are important to real estate companies or to REITs. We have the price to AFFO. It says it's about 20% undervalued. And then forward looking is about 26% undervalued. Then the trailing price to funds from operations, it says it's about 30% undervalued. And forward looking is about 32% undervalued. So in my opinion, that tells me that we are dealing with a company that's potentially really undervalued. So again, it matches the trifecta I like to see in companies I want to buy. And one cool thing about us being an owner of this company is that when we see these properties in San Diego or Boston and you walk by them, they're impressive campuses. And you realize you own a piece of that. And they're paying you well while you own it. And you have the sweetened potential of stock price appreciation. Now I'm going to share with you one more of the approximately 20 stocks I've been buying over the past month. And this stock also has a nice history of dividend growth and I believe is also fundamentally undervalued right now. The company is NNN REIT. It too is a real estate company. Let's dig in. It has a nice high starting dividend yield of 5.64%. So you get paid nice dividends right from day one. And what does their dividend history look like? It's almost the perfect chart. Notice going way back here to 1993, it was paying about 28 cents per share. And over time, it just continues to slowly grow that dividend. So that more recently, it just had an increase. And more recently, it's paying 60 cents per share. Notice how nice this chart looks. Now compare that to the stock price. And kind of how all over the place is. Now I'm going to maximize this stock chart here. Just notice it's kind of all over the place. And that's one reason why I like these dividend paying companies. It doesn't really matter what's going on with the stock price. We still get these nice, consistently growing dividends in these consistently profitable, mature, stable companies. But we get that kicker up front because we're buying it at what I perceive as a discount. So the question is, do you agree with me? Well, let me show you some of the fundamentals. All right, here we see total revenue, a nice looking chart. It's growing over time. I think that's pretty easy to see. Now we'll go down to our operating income. It too looks nice. It's sloping just the way we want it, nice and up and to the left in this case. So that looks good so far. What about net income? Well, we see a little down year there in 2020, which is to be expected in a real estate company, but overall we see the chart looks really good. This is what we want to see in a company that we own. Now let's take a peek at our balance sheet. Notice that over time our assets are growing, not at a wild pace, but at a consistent pace. And then here we have our liabilities. Notice that it too is growing, but does not appear to be outpacing the assets. And here we have total common equity. It too looks good. It's consistently growing over time. And finally, total equity. It too looks good. Although we've had some down years over the past several years, it too is consistently growing over time. Now, what about our cash? We see again that it has nice, consistent growth. It's exactly what we want to see in a company that we're owning. All right, so the financials look good to me. What about you? Do you think they look good to you? Now let's look at valuation. Are we buying a company that is potentially undervalued? And if so, by how much? Because if valuation is low, we again have the trifecta here. We have a high starting dividend, nice consistent dividend growth, and now can we buy this thing at a discount? Let's see. Our dividend yield here says that we're about 21% undervalued. So that looks promising. Now, because it's a real estate company, we want to look at its AFFO and FFO. So price to AFFO trailing is a 15% discount, and price to AFFO forward looking is a 21% discount. Then when we get to FFO, it is a discount, but not much because it's both under 10%. So overall, we do see a company that does appear to be trading at a discount, although it's not as good of a discount as the last two. But again, we have a high starting dividend yield, we have consistent growth, and I believe I am buying it at a discount. Now, if you buy this company like I've been doing, what are you actually buying? Who is their customer? Because that's important. Their customer is your customer because you're the owner. Let's take a look here. So they have over 3,600 properties, and the average length until the lease expires is right at 10 years. So that looks good. They own over 38 million square foot of space. It's 37 different lines of trade. They have about 400 tenants, and they're in all 50 states. Now, who exactly are their tenants? Here you see their top tenants here to the left. Notice it's businesses that aren't affected by the internet, like 7-Eleven, car washes, Dave & Buster's, Camping Worlds. So we consistently see a lot of companies that for the most part are not negatively affected by internet-based businesses. I strongly encourage you, please don't take my word for it, do your own research. But there is one more piece I want you to consider when you're looking to add to your portfolio, and that is position sizing. I'm very strict about my position sizing rules. I don't want any one ticker symbol to be 2.5% to at most 5% of the overall portfolio. When it comes to sector allocation, I don't want to just be in real estate. I want to be in everything, and I want to be diversified. I don't mind being a little more overweight in a sector I believe is undervalued, but I still want to be well diversified by sector. And here you see the breakdown of my $140,000 portfolio by sector. Notice communication services, I'm at 15%. Consumer discretionary 6%, and going down here to energy, it's a 4.26%. Financials a little bit heavier at 16%. Healthcare, which I believe is a sector that's kind of beaten down right now, right at 14.87%. Then going down here to real estate, which is a few of the ones I just shared with you, right at 14%. And finally, utilities is almost 7%. So you see a nice diversified portfolio. I'm not overweight in any one sector. So you might be thinking, well, Randy, how are you buying all these companies you think are undervalued? Well, one way I do that is by selling options in my main ops trading account. I then take some of that cash and buy companies outright in my outright stock ownership account. And that's the account I just shared with you. If you'd like to get an alert whenever I buy a stock or sell options, check out the benefits of becoming a patron down at the link in the description below. The key to buying high dividend paying stocks properly is not just buying a high dividend yield, it's buying a yield that will grow over time and in a company that is undervalued. To see how much dividend income I received from my $140,000 dividend portfolio last month, check out the video at the link above and down in the description below. Until next time, happy investing, and we'll see you again soon.